Hello, welcome back. In this video, we are going to talk about Exxon Mobil, which is also a subscriber recommended company to take a look at, and it makes a ton of sense right now with oil prices surging. We're going to talk about oil a little bit as well. And oil is a little bit of a dirty industry, no pun intended here. You have to be super careful about investing in oil because you can end up losing all your money if you do something wrong or you actually invest in the wrong periods of time. Now, oil is a very strongly cyclical industry, meaning that it goes up and down a lot. Take a look at the max chart of Exxon Mobil here. You will see that there are periods of expansion and sometimes strong and long periods of expansion. Now, this is of course the max chart. You cannot see the finer details in the previous years. But you can see in the last few sort of like decades or so, that has been going up and down and then up and then down, down again and then up. If you take a look, for example, at the 5-year period, you will see in the last 5 years, it has been going up and then little by little, kind of trading a little bit sideways and starting to go down, and then again up, then up again. And this is how oil behaves. Let's take a look at another company, Chevron in this case, which is another oil company. See if they are behaving in a similar pattern here. Let's take a look at the max chart. Again, you will see down periods, up periods, down periods, up periods, down, up. That's exactly how oil works. And it's really important, it's actually key to invest in very strong oil companies if you are looking to invest in oil. Because if you go for the relatively unknown ones, you can actually end up losing money. Like, for example, Chesapeake was a recent 2020 bankruptcy. So you have to be very careful about these kinds of companies, especially when you want to be trading oil, and make sure that you buy them at the proper time and then ride the wave and be ready to sell immediately as the wave starts dissipating. Now, if we enter a recession, it's possible that oil prices will start going down, but as we have some wars and things of that sort, typically oil tends to be going higher if there's like instability worldwide. And so right now it may be an interesting opportunity to have a little bit of oil in your portfolio. I actually own Exxon right now, and I do fully think that there's a strong possibility that this will go more than 100 soon, based on what is happening right now. But I don't think it's gonna be there for a long time. So it's very possible that at some point oil prices will tumble again, and thus the stock prices of these companies will also tumble. Now, cyclical companies are great for like large investors and people who actually understand how cycles work to invest in because they are predictable. And so this is why you are looking at somebody like Warren Buffett actually buying oil right now, because it is predictable what is happening with oil. It's predictable that oil will very likely go higher, and he's aiming to buy the strong companies, the ones that play an important role in the oil distribution. Exxon is one of the strongest ones worldwide, actually, and so this is why I'm holding this one, actually. So, what is going on with the company? Again, financials matter, of course, but what really matters with these companies is taking advantage of the cycle and be ready to sell when the cycle is over, so you have to stay vigilant. Now, the P ratio of the company at 15 right here, you will see it going down and up a lot because, again, very cyclical industry. It will shift depending on what is happening worldwide. And the same thing with the price to free cash flow over here. Now, the outstanding shares are about the same, and the company is pretty solvent, a very key thing. You really don't want a company that has a lot of debt, especially when you are looking at oil companies, because they can go down very quickly if they have a lot of debt, and it will more than likely happen with a lot of these smaller companies. So you want to avoid debt with oil companies like the plague. Super important. And the company's revenue growth has been increasing, net income growth also increasing, very little though, it's about the same. Remember that we had pretty much stability in the previous years in terms of oil. You may be looking at a little bit of a steeper increase in the next year or so maybe. Free cash flow growth that has been increasing, and total equity growth that has been slightly going down. Okay, now you will see here that their margins are relatively suppressed, but they don't have a lot of debt. And again, this is something that I love to see. Debt to equity ratio of 0.2, meaning that the company has much more equity than debt. Love to see it. It's probably more than likely a relatively safe play that you would be able to get out if things go wrong. So yeah. Dividend yield of 3.9, almost 4% here. The free cash flow payout ratio is 41%. The net income payout ratio 58, a little bit elevated, but what we mostly care about is the free cash flow payout ratio. So things are looking fine in terms of the dividends. We can take a little bit of a closer look at the finer details, and you will see that in terms of dividends, Exxon has been increasing them pretty much every year. Another nice thing to see, because this shows stability even throughout bad years. And the effective dividend yield is 3.89, the exact one if we take a look at the current price right now. But the 12-month one, it's about 4. Okay, let's go back, and I'm going to examine some details actually about the income statement. Before I do that, I'm actually a little bit curious about the price targets, just to see what analysts are saying here. Interesting to see. They are pointing at price targets of, yeah, about 104, 102, 110. I think we're going to be reaching these prices, to tell you the truth. Maybe around this is where my price target is, and I may be looking to sell a little bit as well. Okay, let's go back and take a look at the financial statements. Again, you will see a little bit of the same in terms of revenue. It's practically a little bit more, but not much more. And if you take a look at the net income, 19 billion to 23 billion over here. Again, a little bit of an increase, with some years that have been negative, expected when oil is not doing well, of course. And assets of the company, total equity, has been going a little bit down. It will probably increase in the next year or so. I'm expecting that, fully expecting it to increase. Again, a very, very cyclical company and a very, very cyclical industry, really. You want them to have quite some cash, you want them to have quite some assets and not much debt, what we talked about a little bit earlier. You can see that their debt is 47.7 here, but their equity is much, much more than this. Now, 47.7 is not a little debt, of course, and the total the total liabilities, let me find it here, the full total liabilities is 163 billion, which is a lot of total liabilities, of course. But if we take a look at the cash flow, they are making 36 billion. So their total liabilities can be paid in about 4 or 5 years or so, right? So that is, generally speaking, good enough and more than likely safe if the company is doing that well. Although remember, you can have years that can be a massive slump, like last year. And the previous years were lower too. It's right now that the company kind of compensates for what they have already lost. This is how the industry works, really, in this case. But we don't want them to amass a lot of debt. Very, very important. Remember that they had like 45 billion and their free cash flow is 36. They can basically pay, or the vast majority of their debt, just by the last year's free cash flow. And I'm pretty sure 2022 is going to be similar. So probably they are fine. And their cash reserves are still increasing from 2017, even though they had the massive slump. They still have more cash at the end of this period, which is very, very nice to see. Now, we do want to take a look at the stock evaluation tool. Although, for this kind of play, you can actually buy it as a trade and not necessarily as a long-term play. I'm not myself buying oil as a long-term play. I think it's a very, very bad idea to do that. You want to be buying oil when the prices are low. Bet on companies that don't have a lot of debt, so they have cash reserves, they have lots of assets. So basically, they won't be going down anytime soon as you are waiting for the reversal, because it's always what happens with oil. It goes down, it goes up. And when it goes down, it will go down a lot. So you have to be super careful and buy these companies that are very, very solvent. And over here, let's just take a look at what our stock evaluation tool is telling us. Now, for the revenue growth, you can see that it is all over the place, expected, because some years are going to be bad, some years are going to be good. I will go very low here, because the point of this exercise is not really to find that the best price to buy here, is to see whether you are very, very far from a good price to buy, because again, this can be a trade, not really a long-term play, and you can buy expensive and sell even more expensive, because that's how the market operates. Yet you have to be again vigilant of a market crash, an oil crash, which I don't expect to happen soon. But this is how it works. This is mostly going to be a trade. At least that's how I would recommend it to be. Not a long-term play in oil. Not a good idea. The net income margins, let's go like 3, 5, and 7. And the free cash flow margin, let's go like 70, 80, and 79. 70, 80, and 90. 13% for our annual return. And if we hit calculate, let's see what we're getting. And as I would guess, we're getting a lower value, of course, for all our estimates. And this is why it pays to buy oil when it is much lower, when we are in the period where it's actually deflating and not where it is, when it is expanding as it is right now. Even though I think at this current price you can still catch a little bit of a gain as it goes higher, it pays much more to buy it earlier, again, when there is like a deflationary period. And if you take a look at the stock analysis chart, you had a lot of time to do that. Because if we take a look at the 3-year period, look at these numbers over here, about 30 or so, back in 2020, that is, November. And you'll see that it slowly started creeping up higher. And that's exactly how it works. And this is why you would want to buy it at the deflationary period and not as it is inflating. Very important. And as you see right now, we are almost sitting at the highest of the highs. So you have to be super careful, because we are at an already high price where there is a lot of resistance here from previous buyers. Although I fully expect again that it's very likely to surpass the $100 level and then even creep up higher. I wouldn't be surprised by that at all, especially if the current market slump continues and the stock market gets annihilated overall. So thank you for watching this. I hope you enjoyed the video, and I gave you some ideas. This is how I like trading my oil. And please leave a like and subscribe if you're around. And if you want to get access to this tool, remember that you can become a Patreon. You can find links in the description box below this video. And you can support the channel, of course, doing that, and get unlimited access to this tool, which I use daily in my videos. I love it and I keep working on it. And thank you for watching this one again. I'll see you soon. Bye-bye.